Look, I'm going to tell you something that's going to make you uncomfortable. Right now, while everyone's hiding under their desks worrying about interest rates and recession headlines, the smartest money in the world is doing exactly what they should be doing, buying distressed assets at prices that won't exist 6 months from now. And I know what you're thinking. You're thinking this is some kind of motivational garbage, some guru telling you to catch a falling knife. Let me be clear, I don't do motivation, I do math. And the math right now is screaming at anyone who's paying attention. Distressed assets are not about being brave. They're about being rational when everyone else has lost their mind. I've spent 50 years doing this, and I can tell you with absolute certainty that the best returns I ever made, and I mean the absolute best, were when I bought buildings, companies, loans, whatever, when the seller was more terrified than I was greedy. That's not courage. That's just understanding that markets overcorrect, always have, always will. The pendulum swings too far in both directions, and your job as an investor is to be there when it swings too far in the direction of panic. Right now, we're in a moment where capital has gotten expensive very quickly. The Fed has jacked rates faster than almost any time in modern history. Credit markets have seized up in certain sectors. Private equity guys who spent the last decade levering everything to the moon are sitting on portfolios they can't exit and can't refinance. Regional banks are terrified of commercial real estate exposure. You've got office buildings in second-tier markets trading at 40 cents on replacement cost. You've got over-leveraged operators who bought at 3% cap rates in 2021 who are now staring at debt maturities they can't meet. This is not a tragedy. This is an opportunity. This is exactly where fortunes get made. But here's the thing nobody wants to hear. Distressed investing is not about buying garbage and praying. It's about buying good assets from bad balance sheets. There's a massive difference. A great building owned by an idiot is still a great building. A terrible building owned by a genius is still a terrible building. Right now, because of how fast the cost of capital moved, you have fundamentally sound assets being sold by people who are in financial distress, not because the asset is broken, but because their capital structure is broken. That is the sweet spot. That is where you make generational wealth. Let me explain what I mean by capital structure risk versus asset risk. Asset risk is when the thing you own is actually impaired. The building's in the wrong place. The demand isn't there. The replacement cost is below what you paid. That's asset risk, and you should avoid it. Capital structure risk is when the asset is fine, but the owner took on too much debt at the wrong time with the wrong terms. Now the debt's maturing, the lender won't extend, and the equity's getting wiped out. The building still works, the tenants are still paying rent, the location hasn't moved, but the capital structure is killing the owner. When you can step in and buy that asset at a basis that reflects their panic, not the asset's fundamentals, you are buying future cash flow at a discount that is almost impossible to replicate in normal markets. I'll give you an example from my own history. In the early 90s, the savings and loan crisis destroyed the commercial real estate market. Lenders failed. Developers went bankrupt. Buildings were being sold for less than the cost of the land. Everyone said commercial real estate was dead. The RTC was dumping assets. Nobody wanted to touch it. I bought everything I could find. Why? Because I understood that the underlying demand for space hadn't disappeared. People still needed offices. They still needed apartments. They still needed places to put their businesses. The problem wasn't demand. The problem was that the previous owners had overpaid with too much debt, and when the music stopped, they had no chair. I didn't overpay. I didn't over-leverage. I bought at replacement cost or below, and I waited. And when the market normalized, those assets became the foundation of a fortune. The same thing happened after the financial crisis. Everyone thought the world was ending. Real estate was toxic. I was buying. I bought distressed loans. I bought office buildings in major cities at prices that made no sense if you believed the world was going to keep functioning. And guess what? The world kept functioning Demand came back. Supply had been constrained because nobody was building. Cap rates compressed. Properties that I bought at 6 or 7% cap rates were worth 4 caps 5 years later. That's not genius. That's just showing up when everyone else is running away. Now, you might say, okay, Sam, but how do I know when it's actually distressed and not just a falling market that's going to keep falling? Great question. Here's the filter. You need to ask yourself 3 things. 1, is the asset's distress driven by a temporary capital markets dislocation or a permanent demand destruction? If it's capital markets, that's good. If it's demand destruction, you wait. 2, can you buy it at or below replacement cost? If you can't build it for what you're paying, you're already protected on the downside. 3, does the asset generate free cash flow, or are you dependent on appreciation? If you need the market to bail you out, that's speculation. If the asset pays you while you wait, that's investing. Let me tell you what I'm seeing right now that fits this framework. Office buildings. Everyone thinks office is dead because of remote work. Let me tell you something. Office is not dead. Bad office is dead. Buildings in tertiary markets with low ceilings and no amenities that were already struggling before COVID, yeah, those are done. But Class A office in primary markets with long-term leases to credit tenants, that's trading at a massive discount because the narrative is that nobody's going back to the office. That's insane. High-value companies want their people together. They want collaboration. They want culture. They're going back to the office, but they're going back to better offices. And those better offices are now available at prices that reflect a world where office doesn't exist. That's a mispricing. Multifamily in certain over-leveraged Sunbelt markets is another one. Developers went crazy in 2021 and 2022 building apartments in places like Austin, Phoenix, Nashville. They underwrote rent growth at 5, 6, 7% a year because that's what it had been. Then supply hit the market all at once. Rent growth stalled, and now they're sitting on floating rate debt they can't service. The buildings are fine, the locations are fine. The problem is the developer's pro forma was fantasy and their lender wants out. If you can step in and buy those assets at a basis that assumes normalized rent growth and rational leverage, you're going to do just fine. I'm also looking at distressed credit. There are loans on good assets that are trading at 70, 80 cents on the dollar because the lender doesn't want the headline risk of owning real estate, or they're a regional bank that got told by regulators to clean up their commercial real estate book. You can buy that loan, restructure it with the borrower, or take the asset back, and either way, you're acquiring a position at a discount to where the asset would trade in a normal transaction. This is basic math. If a loan on a $100 million property is trading at $70 million, and you can either make the loan work or take the property back, and it's actually worth $90 million in a stabilized market, you just made $20 million by being willing to do the work. Now let's talk about what you need to survive in distressed investing, because this is where most people fail. You need liquidity. You cannot be a forced seller. I don't care how good the asset is. If you have to sell because your own capital structure is broken, you're going to lose. Liquidity equals optionality. Optionality equals value. If you have cash and everyone else needs cash, you set the price. If you need cash and everyone else has it, they set the price. It's that simple. This is why I've always been obsessed with keeping dry powder. I don't care if it feels inefficient in bull markets. When the market turns, the guy with cash is king. You also need patience. Distressed investing is not a trade. It's not something you flip in 6 months. You're buying assets that are mispriced because of temporary dislocations. Temporary doesn't mean next week. It means over the cycle. If you're buying because you think you can flip it to the next guy in a year, you're not investing, you're speculating. And speculation in distressed markets is how you go bankrupt. You need to be able to hold the asset, collect the cash flow, and wait for the market to come to you. If you can't do that, don't play this game. You also need to understand the difference between distressed and broken. Distressed means the asset is good, but the situation is bad. Broken means the asset itself is impaired. A mall in a dying town is broken. An office building in a growing city owned by an over-leveraged sponsor is distressed. You want distressed, you do not want broken. I see people all the time buying assets that are cheap because they're worthless, and then they act surprised when they stay worthless. Price is not the same as value. You need to understand the difference. Let me also talk about what's happening in the private equity world right now, because this is creating massive opportunity. You've got PE firms that raised huge funds in 2020 and 2021 and deployed that capital at valuations that made no sense. They levered up portfolio companies. They underwrote growth that hasn't materialized. Now they're sitting on portfolios that are underwater, and they have LPs who are demanding distributions. They can't exit at the prices they need, and they can't hold forever. So what happens? They start selling assets at discounts to get liquidity. They start doing secondaries at painful valuations. This is creating opportunities for people who have cash to step in and buy businesses or parts of businesses at fractions of what they were valued at 2 years ago. I'm seeing the same thing in venture. You've got venture-backed companies that raised at billion-dollar valuations that are now running out of cash and can't raise at those valuations anymore. The VCs don't want to mark them down. The founders don't want to take the dilution. But cash is running out, so they're either going to shut down or they're going to take a deal that's punitive to everyone except the new money coming in. If you can identify which of these companies actually have real businesses underneath the hype, you can buy them at prices that give you huge asymmetric upside with limited downside because you're coming in at a reset valuation. Here's the part that most people don't understand about distressed investing. It's not about predicting the future. It's about buying assets where the downside is protected and the upside takes care of itself. If I buy a building at 60 cents on replacement cost and it generates a 7% cash-on-cash return, I don't need to predict when the market's going to recover. I'm getting paid to wait, and when the market does recover, I'm going to make a multiple on my money. But even if it takes 5 years, I'm still getting 7% a year while I wait. That's a very different risk profile than buying something at full price and hoping it appreciates. This is also why I obsess over free cash flow. If an asset doesn't generate cash, it's not an asset, it's a bet. And bets are fine if you're gambling, but I'm not gambling, I'm investing. I want assets that pay me. I want businesses that generate cash. I want to be able to sleep at night knowing that even if the market stays bad, I'm still making money. That's the discipline. That's the difference between being an owner and being a speculator. And let me tell you something else about cash flow that nobody talks about. Cash flow is information. When you own an asset that generates cash, you learn things. You learn about the market. You learn about your tenants. You learn about operating efficiency. You learn what works and what doesn't. That knowledge compounds. When the market turns and everyone's rushing back in, you already know which assets are the best, which markets are the strongest, which operators can execute. You've been getting paid to get educated while everyone else was sitting on the sidelines complaining about cap rates. That informational edge is worth as much as the cash flow itself. I also want to talk about something that drives me insane, which is this idea that distressed investing is somehow opportunistic or predatory. Let me be very clear about something. When I buy a distressed asset, I am providing liquidity to a market that has none. I am taking risk that nobody else will take. I am solving a problem for a seller who has no other options. That's not predatory, that's capitalism. The seller is better off selling to me at a discount than going bankrupt and getting nothing. The lender is better off selling me a loan at 80 cents than foreclosing and spending years trying to work out the asset. The market is better off having someone step in and stabilize the asset than having it sit vacant and deteriorate. Everyone wins. I just win more because I took the risk when nobody else would. And that's the thing about distressed markets. They're not efficient. In efficient markets, information is widely distributed, capital flows freely, and prices reflect consensus value. In distressed markets, information is scarce, capital is frozen, and prices reflect desperation. If you have information and capital, you have an enormous advantage, but you have to be willing to act when it's uncomfortable. You have to be willing to buy when the headlines are terrible. You have to be willing to be the only bid in the room. I remember in 2008, 2009, I was buying assets and people thought I was crazy. The financial system was collapsing. Lehman had failed. AIG had been bailed out. Everyone was convinced that real estate was going to zero. And I'm out there buying office buildings and apartment buildings and distressed debt. People asked me how I could sleep at night. I slept great. You know why? Because I knew what I owned. I knew what I paid. I knew what the cash flow was. I knew that even if the world stayed bad for 5 years, I was still going to make money. And I knew that eventually the world would normalize, and when it did, I was going to make a fortune. That's not luck, that's discipline. Let me also talk about leverage, because this is where most people destroy themselves in distressed markets. Leverage is a tool. It amplifies returns when you're right and amplifies losses when you're wrong. In distressed markets, you need to be very careful with leverage because you're already taking risk on the asset side. If you layer financial risk on top of asset risk, you're asking to get wiped out. I've always believed in conservative leverage. I want to make sure that even in a bad scenario, I can service my debt and hold the asset. I'm not trying to maximize my IRR on a spreadsheet. I'm trying to make sure I survive. Survival is the game. If you survive, you win. The other thing about leverage in distressed markets is that it's often not available, which is actually good. When debt markets are frozen, the only people who can play are the people with equity. That reduces competition. That improves returns. When everyone can lever up, returns get compressed because you're competing with borrowed money. When nobody can lever up, returns expand because you're only competing with real capital. So when people complain that debt is expensive or unavailable, I see opportunity. It means the competition is thin. Now let me talk about portfolio construction because this matters. You can't put all your money into one distressed asset and hope it works. You need diversification. Not diversification for the sake of it, but diversification across different types of distress, different markets, different capital structures. Maybe you buy some distressed real estate, some distressed credit, some undervalued private companies. Maybe you spread it across different geographies. The point is that you're building a portfolio where if one or two things don't work, it doesn't kill you. And if most things work, you make a fortune. That's risk management. That's how you compound capital over decades. I also want to address the psychology of distressed investing because this is harder than people think. It's easy to say you're going to buy when everyone's panicking. It's a lot harder to actually do it. When you're the only person bidding on an asset, when everyone around you thinks you're insane, when the headlines are screaming that the world is ending, it takes conviction to write a check. That conviction comes from doing the work. It comes from understanding the numbers. It comes from having lived through cycles before and knowing that they always turn. If you don't have that conviction, you're going to panic and sell at the bottom just like everyone else. This is also why I don't invest based on macroeconomic forecasts. I don't know where interest rates are going to be in 2 years. I don't know if we're going to have a recession or not. I don't know what the Fed's going to do. Nobody knows. And anyone who tells you they know is lying. What I do know is whether an asset makes sense at the price I'm paying with the cash flow it's generating. If it does, I buy it. If it doesn't, I don't. I'm not betting on the economy. I'm betting on the asset. That's a much more controllable bet. Now, I told you at the beginning that I was going to tell you where I think the next big distortion is forming, and I'm going to keep that promise. Everyone right now is focused on commercial real estate and tech valuations. And yeah, there's opportunity there. But the thing almost nobody is paying attention to is the small to mid-sized private company market. You've got millions of businesses owned by baby boomers who are aging out. They don't have succession plans. Their kids don't want the business, and they're facing a market where buyers are scarce because debt is expensive and PE firms are focused on larger deals. These businesses are going to get sold at distressed prices, not because they're bad businesses, but because the sellers have no leverage and the buyer pool is thin. If you can identify which of these businesses have real cash flow, real customer bases, and real defensibility, you can buy them at valuations that are absolutely stupid relative to their earnings power. And because nobody's paying attention to this space, you don't have competition. You're not bidding against 10 PE firms. You're often the only buyer. That gives you pricing power. That gives you the ability to structure deals on your terms. And if you can buy a business at 4 or 5 times cash flow that's been around for 30 years, has a loyal customer base, and generates consistent earnings, you're going to do extremely well. The other distortion I'm watching is in agricultural land and water rights, particularly in regions facing long-term water scarcity. Everyone's obsessed with tech and crypto and AI. Nobody's thinking about the fact that water is becoming scarce, populations are growing, and you can't create more land. If you can buy agricultural assets in the right geographies at reasonable prices, you're buying something with inherent scarcity and growing demand. That's a very long-term play, but it's the kind of thing that creates dynastic wealth. So here's what I want you to take away from this. Stop chasing trends. Stop listening to narratives. Stop buying things because they're popular. Start looking at the numbers. Start asking whether an asset generates free cash flow. Start asking whether you're buying at or below replacement cost. Start asking whether the distress is situational or structural. And start building liquidity so that when everyone else is panicking, you can be the one setting the terms. Distressed investing is not for everyone. It requires capital. It requires patience. It requires conviction. It requires the ability to act when everyone else is frozen. But if you can do those things, if you can be disciplined, if you can focus on fundamentals instead of narratives, you can build wealth that lasts generations. This is the game. This is how it's always worked, and this is how it's always going to work. If you want to think like an owner instead of a speculator, subscribe to this channel. Hit the like button if this made you think differently about where the opportunity is right now. And leave a comment with your investment thesis or your doubts. I'll try to answer honestly, even if the truth is uncomfortable, because that's the only way you get better at this game.